Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. We are back to the duo again this week. Quinn and I, still missing Tyler, but we're hoping to have some updates on that in a couple of weeks. He's out there grinding the multi-strat world of funds. So hope to have him back soon. But a little teaser, we actually just locked in Jem Carson of Kai Volatility Advisors is going to be joining us on the Roundup next week. So that one's going to be a ton of fun. Big fan of the guy. So we'll be able to unpack some stuff there. But for the meantime, Quinn and I this week, what's going on, man? How are you?
Yeah, it's good. We're replacing Tyler with some. He better be careful because we're gonna get some good guests over the coming week.
Yeah. So pretty light week on the economic data side of things, but still lots to talk about. Before we started to hit record, we were just saying that, like, I don't know, for me, this is some of the most interesting FOMC meeting minutes that I've seen in a long time. Like, there's this, a couple interesting paragraphs there, and we'll dive into it. But the more I started to reread it and over, I was like, holy crap, there's like a lot of very interesting things packed into like this single paragraph. So
it was pretty action packed, I would say. And then combining with like last week's very hot inflation data, make that context.
Totally. So yeah, the big stuff is it's all around the granular monetary plumbing stuff, the wonky acronyms and all of that fun stuff. But there's a few just key highlights here I wanted to underline here. So on the top, this top sentence here of a number of participants also discuss some issues related to the balance sheet. So that's the big theme here. So diving a little bit deeper, the big one that started to make the headlines was regarding the potential for significant swings in reserves over coming months related to debt ceiling dynamics. Various participants noted that it may be appropriate to consider pausing or slowing balance sheet runoff until the resolution of this event. So what's really tied at the hip here is what's going on with the debt ceiling situation. So there's a few things that start to happen once the debt ceiling is hit. Basically, the Treasury goes into basically what I would say is preservation mode to avoid any sort of debt default of not paying interest payments on existing Treasury debt. So to do that, they do a few things. And the first phase of that is this extraordinary measures things, which we've already talked about on the show, but it's just basically trying to cut the meat of non-essential commitments to basically shore up that money to be able to fund mandatory obligations. And then once that's done, then they start to draw down the TGA account, which is the Treasury General account. And that's sitting at, I haven't looked at it recently, but it's around $800 billion is the target that they want to hit. So that gets drawn down. And then what happens is you hit like an X date where if the debt ceiling doesn't get resolved, that's where the default can actually happen. That's generally the moment where, suddenly all the politicians come together, sing Kumbaya, and raise the debt ceiling further. So the implications of that is that dynamic of drawing down the TGA brings forth a lot of bills into the market, it pulls it back. And then as we reverse and we have to rebuild the TGA account, they have to issue a ton more bills. And what was great about the last time this happened in 2023 is you had the reverse repo facility that was sitting, it had plenty of room to take the buffer of all that bill issuance to come out of the RRP and into the TGA. But this time the RRP is sitting at like 70 million. There's hardly anything left in there. So they need to be a bit more conservative in how they go about rebuilding this TGA. So I think that's what they're pretty concerned about here, and that's where they're saying that we need to potentially pause QT. So Quinn, I want to ask if there's anything I missed there around your take of what this really implies.
Yeah, no, I think, and just so the trolls in our chat, it's, I think you said million, it's 70 billion in the RRP, but so you don't get any, that. But I think it's clear, and things are very centrally planned. We've been talking about that for a long time. And between Powell and Yellen, it's most obviously the case. And it's continuing to be the case after this section, when we get into some of Bessent's comments and the Treasury and policy actions. There's some things I want to talk about on that coordination front. But yeah, I think everybody, it's not surprising that the QT ending discussions are being started, because we know how long of a lead time they want to give market participants, and everybody had been expecting it sometime this year, whether that was March or April or March or June or May or later. So it kind of makes sense that they're starting to float it with leaving the optionality open for when it actually occurs. But to me, like they're going to push this till the very end on the budget stuff, because there's so much that they're going to try, and unless they split it up, there's tax code, a lot of the other, trade, tariff, all these things. So it makes sense to me that they would kind of start this, and Bessent's obviously trying to get Powell to, and maybe that's why Powell's been hawkish, right? He's maybe receptive to ending QT and maybe not cutting rates, which is kind of a compromise for Bessent's request, probably.
I think the other big interesting section from this, and you actually tweeted this out yesterday, but just discussing this section, let me just get my bearings. Many participants expressed the view that it would be appropriate to structure Treasury purchases in a way that moved the maturity composition of the SOMA portfolio closer to that of the outstanding stock of Treasury debt, while also minimizing the risk of disruptions to the market. So really what that says in plain speak is they want to shorten the maturity profile of the Fed balance sheet. They want to own more bills over more bonds effectively. And they want to match it to basically what is the actual ongoing composition of the debt being issued. So Quinn, you want to unpack what this actually means here?
Yeah, basically. So yeah, I had a tweet about it, but what's going on is the percentage of bills that comprise the total U.S. debt right here. This slide is 22.4, and then there's the TIPS and FRNs. So non long duration, just straight notes is around 30ish%, let's say. But just looking at the bills, 22. The Fed themselves, their Treasury holdings, the composition of those is only less than 5% bills. So basically, the Fed skews their ownership of U.S. Treasury securities to long duration bonds and notes, meaning they're providing more support to the long duration bond market, and all else equal, suppressing long duration yields more than they are the front end, 0 to 2 years. So that is meaningful, because we're talking trillions of dollars here, right? So the Fed needs to go from to equal weight, to just equal weight, not even a bills only policy, which is also being floated. Like there's a camp that wants to remove their influence of the long duration bond market altogether. But even just to go from what they are today to benchmark weight, they need to take their bills holdings up from 4.5 to 22, which basically reduces their bonds from 95 to 78. And that is effectively QE. I know Constantine's calling it QE2, because you are ending the runoff. So the balance sheet
shrinkage. QT 2.0.
Yeah,
you
exactly.
said QE, yeah.
Oh yeah, QT2, because you're ending the shrinkage balance sheet altogether, but you're increasing the duration of it via the composition, which sort of has a similar effect on the market and in terms of a steepening of the yield curve. So that's why they're trying to do this very, effectively, in coordination, cautiously, because there's a lot of moving pieces here, and it is threading a needle to do this appropriately without the bond market freaking out, with all the duration that needs to come from both the Treasury, increasing their total coupon issuance, terming out more, and the Fed selling more as well. So it's a tricky situation. I think Bessent's done a good job of communicating all of this in some of his recent interviews, actually, in a very, somewhat frankly, surprisingly transparent way.
Yeah, I feel like so. I mean, basically, what we're getting at here is that there's some camps that want to get back to a pre 2008 Federal Reserve balance sheet management system, which is before QE, before they started to have a whole portfolio of longer duration bonds and even mortgage backed securities. Before that age, we were in a world where you can see it in this chart, right? Like back in the was at the 80s, percentage of bills ownership was a lot higher than it is today. So it's sort of thinking about how do we get to that next phase here, and the big question at hand is how do you navigate that without blowing up the long end, the long bond yields. So yeah, I mean, to your point, there's what's happening on the Fed side of things, and then there's what's happening on the Treasury side of things of what Bess is talking about, and it's very interesting to see how these two components and drivers are coming together right now. As you mentioned, there was this Scott Bessent interview that came out this morning. He was on Bloomberg, and a lot of very interesting components in there. But one of them, and he mentioned this again, like it's really funny to compare how Yellen talked about her meetings with Powell, which was trying to avoid it at all costs, versus Bessent's like, yeah, we just met for breakfast yesterday. We had a great chat. So, there's a lot more openness about what the intentions are. And one of the big ones, and Bessent's been getting some flack about this because, like pre-nomination, he was all about terming out the debt. And now he's saying there's no plans of terming out the debt anytime soon. Yeah, what was your take on that? I have a feeling that you're, not on the side of clowning him for that one.
Yeah. So just to summarize for people why a lot of everybody, from my understanding of social media and news headlines, was that everyone was celebrating the end of QT being bullish. And to summarize why actually I think the takeaway from those meetings is actually not that bullish is because the end of, like, QT is reducing the size of balance sheet and selling duration into the market effectively, or buying less. And the Fed basically has to continue selling duration into the future of their treasury book. So it's to me, the bigger story is that QT, as we sort of know it, or at least the negative effects for asset prices, is sort of slated to continue well into the future. On to Bessent, this is where I think it's actually, very interesting, because the narrative around Trump and his administration is, and Main Street over Wall Street, small caps over large caps, value and cyclicals over like large cap, Meg 7 big tech. But the problem is that policy at the moment from the Treasury and Fed together is very much a continuation of the same framework that has been going on. So the main things are the QRA. They are not increasing duration, which is something that Yellen really altered significantly. And Bessent, in his interview this morning, said he's just continuing the policy. He's not reducing duration even further. But then when you pair that with the talk of the SLR exemption, which I'm still not quite sure why that just all of a sudden came up now post recent weeks, it's clearly, I think, a Bessent driven priority, coming back channel into the Fed. That is also very supportive of the long end, relatively speaking. So it's both of these things in tandem reduce pressure, all else equal, on the long bond, which then, all else equal, if the long bond yield is lower, that's all else equal stimulative for the economy rather than letting it rise and bear steepen. But that's sort of the problem of the last few years, where it's that suppression of the long bond is allowing the Fed to stay higher for longer on the front end, which is this exact mismatch and imbalance of favoritism, essentially, of companies, small caps, getting hurt because they finance on the artificially high front end, and large caps financing on the back end. So that's the predicament. And that's why you're seeing NASDAQ outperform Russell, right? Even though Trump's supposed to be pro Main Street, pro, average Joe pro cyclicals, and deregulation should help this over time, but right, it takes a while for this policy to enact. Tax cuts, you would imagine, would favor, the lower end. But what you're seeing is this policy is still actually favoring, until the Fed starts cutting again and the curve starts steepening again. It's actually very favorable, all us speaking, for the same conditions as before. So yeah, I think I understand the reasoning. The reasoning is inflation is still problematic, and if they do it all at once, then you just crush the markets, and they need to massage the slower in a very coordinated manner. Which I think my fear is that the market is wrongly sort of misplacing extreme confidence, given off by the Trump admin's very competent team, which I believe these guys are absolute rock stars. But, they also know that there needs to be this sort of digestion period, rebalancing kind of pain change that should be front loaded. And to me, that's sort of the action they're taking. And that's why I just can't get really comfortable with amazing upside in risk assets right now.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. It feels like they're trying to navigate this tightrope that they're walking, and you can, obviously we can't be in those breakfasts between Bessent and Powell, but it does feel, I mean, this is what we expected when we saw somebody like Bessent coming in. This is a market operator compared to a PhD economist that was there before in a Fed chair. Is that things are gonna go about differently, and there's going to be more consideration for market nuances. So it wouldn't surprise me if, like, in those breakfasts, Bessent comes in and says, hey, look, like, we have a goal and a mandate, and something we talked about is trying to normalize the Treasury debt issuance profile, but we can't do that right away, especially while you guys are on our throats with QT, which is basically what he said in the interview, right? And he's saying that we want to get there, it's just it's path dependent. And I think those path dependencies include things like ending QT. It includes the SLR exemption, which is, do that, and then that'll allow us to be able to issue more longer term duration debt, and get away from this heavy bill issuance. At the same time, that might also allow you guys on the Fed to be able to get closer towards a normalized balance sheet profile at the same time. So yeah, man, there's a lot of very interesting dynamics happening.
And thus far, they've done a good job of communicating to the market that they're gonna sort of get it done, and the market hasn't seemed to care, and that hunky dory, and we just float here until earnings catch up to valuations thus far. But I'm just skeptical because there's so many ways it could go wrong. I mean, what needs to happen, that the optimal end state, I think, if you were to fast forward a year or two from now, is simply the yield curve is much steeper. The long end is probably about where it is today. There's like not a great bull case for yields to go down on the long end, given all of the supply that has to hit the market over the next few years. And if you want to maintain a 2 to 3% real growth economy with 2 to 3% inflation, that's a high nominal growth rate. And the Fed should be cutting, but they can't cut without seeing the repercussions of their Q4 actions. And so they need to sort of stair step the front end down. And basically, Bessent knows this better than anyone. He needs the 10-year and the 30-year to be probably 5 to 20 bips lower to start cutting rates without it blowing out. And that is simply a matter of growth slowing. Like that, just to me, that's the missing variable here. And I think in his interview, he danced around it a little bit, which he was mentioning they're trying to bring long-term yields down via lower energy prices and deregulation. But there's also this big growth component, which I think is the actual real kind of thing that suffers from Doge, for example. Like, I'm it worries me, or I'm concerned that while everyone's pointing and laughing at DC seeing the effects of Doge, like the government's been the largest employer across the whole US for the last few years. So
Yeah, they
that to me
floated the
is,
labor market like through the past couple of
yeah,
years, and yeah, I mean, to your point about the stair stepping of the short rate, I think that's right. Like, if you, I'm just following back up here in the minutes, but the other interesting section from it was around their view on this recent hot CPI print. So, just in this bottom section here, they said some participants remarked that reported inflation at the beginning of the year was harder than usual to interpret because of the difficulties in fully removing seasonal effects. And a couple of participants commented that any increase in reported inflation in the first quarter due to such difficulties would imply a corresponding decrease in reported inflation in other quarters of the year. So this is shaping up that their perspective is quite similar to what happened last year, where the first quarter we got some seasonally hot inflation prints in the first couple months, and that spooked the Fed. And then what happened is that pretty quickly later on, the inflation rates prints were coming down quite a bit more, and quite cool. And it seems like that's how they're viewing things, which would shape up pretty nicely when you compare that to like where the 2 years at, or where expected Fed funds forwards are at right now. Like, there's almost no expectation of any cut this year. So that's a really interesting situation where it's quite asymmetric to bet on cuts further later into the year, which is quite interesting.
I think it's a good hedge for equities, but if you think back to last year, right? Like this, the Fed wouldn't have cut if it wasn't for a pretty not great growth scare. Like if you go all the way from June into July, where their first cut was September, and maybe they should have cut in July, was they basically admitted it, but so that's a far ways off for the first cut. Like that to me is like a growthy thing. But yeah, we'll just have to let the cards play. I mean, if I just, people also on the more crypto Bitcoin side, like should remember that Bitcoin and crypto peaked in March and stocks peaked 4 months later in July. So, where there's earnings and cash flow growth because of a resilient economy, yeah, maybe the stock market can kind of chop and grind at maybe a shallower rate of change higher because valuations are more rich. But for more liquidity driven assets, it's hard to see a real near term catalyst.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow the journey on X at Scale Network. Maybe not a near-term positive catalyst, but I feel like a lot of the downside catalysts are also somewhat hedged and capped off. Like this was a tweet from, or I mentioned from Fed Bostic this morning, saying that the possibility of slowing QT is not just about that debt ceiling, but it's also about this concern to overshoot. So this is the one that is the other consideration for when to end QT. It's not only just because of this debt ceiling thing. What they're saying there in terms of overshoot is getting into reserve levels that are too low for the system to function. This is a really interesting chart that I've been starting to look at pretty regularly. I actually got it from Conks, who's the monetary plumbing OG and God. But really, this is just a really simple way to look at this idea of and fear of an overshoot. So the last time that they're doing QT and that there was an overshoot was September 2019. That was the Fed repo crisis. And you can see on this chart here how basically what this chart shows is, they call it reserve demand elasticity, but effectively what it means is that when we're near zero, things are good. There's plenty of reserves. If we go below zero, things get scary. You can see how in September 2019, that's when we were getting below that -1, and that was an overshoot. That made them force and capitulate overnight to stopping QT, and that's not a good look for the Fed. So they don't want that to happen again. So right now, reserve demand elasticity is chopping around zero. So things are still good. We're not overshooting yet, but they want to be conscious of that. They don't want to see this chart heading lower. So, even though the liquidity picture isn't as beautiful, and just, as 2021, I still see some pretty positive tailwinds between, having them be concerned about this wanting to end QT pretty substantially. Talk of this SLR exemption that just seems to have taken hold of a lot of different people and stakeholders in recent months or recent weeks. I don't know. It does feel decent to me.
Yeah, I think a very fair base case, and probably mine, is we just chop for many months and there's just no direction. And unfortunately, though, I mean, it's hard to paint a bull case for many non-Bitcoin crypto assets if we're chopping and volatility's hitting the gutter and there's a slow bleed of alt inflation and no marginal buyer coming into the market. But yeah, it does. I don't think at this stage inflation is not breaking out anywhere really. I mean, as I say that, I had a slide in the deck of last week's summary prints, which every single thing came in hot. If you want to pull that one up, that I think that there is, if everything goes as planned, great. But if for whatever reason the persistently strong economy kept, I actually think there's a case to be made that oil is like going to make another run higher here, and that could be problematic. I think people are very sanguine after how easy Canada, Mexico, and Colombia rolled over. I don't think Russia, China, and everyone.
For sure. And here is a chart just to get an idea. Like break evens are grinding upward, and like the 2-year break evens a lot more volatile. But there is an increase, but it's not a major concern yet. It's sort of just slight chopping around. I mean, if you pair it to what we've been talking about over the recent weeks about this manufacturing sector upswing that we've seen, it does make sense, and that's not always necessarily a bad thing. So tying back to one more thing that Scott Bessent mentioned in that interview is this idea of, he keeps hammering it, it's this like non-inflationary growth. So we're always, our heuristics are always so based on recency bias, right? And so we've gone through the last few years of, we have this big inflation scare, and that's why it feels like the market is scared of economic growth. So he's been hammering this idea of non-inflationary growth, which is actually like a thing. It's actually more likely than not. Like inflation and growth are not actually tied to the HEP per se. And I'm a big fan of this guy, Inflation Guy. He has a blog. Like every time he's like an economist, and every time that an inflation print comes out, it's the first person in an article that I read. And he put out a really interesting article this week, just looking at the analysis of like, growth does not cause inflation. We can have stagflationary situations like the 70s, et cetera, but these two things are spurious in their correlation at best. So, he just compared looking at like from 2004 to recent years, and you can see there's times where you can barely see it, but like right around 2010 is a time where we saw like a deceleration in core CPI while the economy was recovering. And he did a pretty decent and robust scatter plot regression here, just looking at, okay, on different lagged and contemporaneous timeframes, what does that regression look like in terms of CPI and GDP? And it's just noise, right? So it's just, they're not interrelated in the way that it feels like a lot of the market expects it to be right now. And you can see that in any time we get like a hot, economic data print, everybody freaks out. And it's like, oh no, we can't be having real GDP growth. Like that's awful is almost the sentiment that it feels like these days. And because they're scared that that's going to cause inflation that we've seen in 2021, 2022. But the argument is that it's more of a fiscal or monetary phenomenon.
Yeah, I agree. I mean, Bessent's point in his interview was pretty prescient around Biden inflation, and the fiscal deficits created a demand shock with his, the regulatory hampering creating a supply shock. I mean, what's going to happen if you don't let oil companies drill, and you have crappy foreign policy, and you let wars go off in the Middle East, and you're funding everybody to bomb each other with your own missiles and everything. Like these are just extremely inflationary things to be aimlessly spending money on, and then like core essential goods you're kind of preventing and investment into, like energy and things. So I think there's a lot of positive there, and I also like, it's pretty hilarious to come full circle on how the US had this period of years under particularly last four and then even before Trump's first term of like idolizing Europe for about everything. And you look at like Germany's industrial, base, and I mean, these countries are absolutely getting crushed and in the gutter, and their inflation is horribly out of control. And now it's flipped, where all I could hear is like how horrible of a person Trump is. And now all these elections in Europe are potentially coming this way because everyone can't afford groceries because they have no energy independence and now no security independence. So I agree that there's positives to be looking forward to. And I just don't know how, if some of these things flare up and are not as easy solutions as the market kind of thinks right now, how smoothly it will look through. Like I mean, you can't just flip a switch and turn on oil production worldwide, right? Like US production is flatlining and rig count is down year over year for multiple years. Like, they want to tighten the screws on Iran and Russia. Like, so there's just
and they want to refill the strategic petroleum reserve. Like I mean, that's the thing. I've been trying to figure that out is like, they want to drill, baby, drill, but like, how do you incentivize oil producers to drill, baby, drill,
higher price.
Yeah. Yeah. So, I mean, maybe that's the case, is that you see that oil rally and that's what spurs it on. And then supply comes online. Maybe.
Yeah, you do. Well, the plan they're going is going to Saudi and trying to strong arm a deal between Russia, Saudi, Ukraine, and get all those barrels flowing, because they also want to put a ton of pressure on Iran too. And Iran really ramped up through the Biden administration from basically nothing to, a couple million barrels a day, and exporting half of that to 1.5, 1.6. So, yeah, there's just they're opening the door to Venezuela now, because that's a big thing. Like, Bessent's a market guy. It's just like these are like at best 6 to 12 month CapEx cycles. You need runway and line of sight to better profitability, and shareholders in these publicly listed US companies are saying, guys, wait for a better price outlook before you're just drilling. Like, start returning more capital to shareholders, things like that. So it's just, some of these things are structural that they can't really control, which I think are the risk factors.
Yeah. I don't know if you caught the Microsoft CEO interview. Did you see that yesterday? About he basically just faded the whole AGI thing and AI CapEx build. Like, he just thinks it's excessive what's being baked in right now and what like his competitors are doing. And I was just looking at like the price action today of the Qs, and maybe partially part of it was the yen rallying pretty hard. We broke that 150 level, which we can talk about too. But there's also this quite interesting interview with the CEO of Microsoft, and he was kind of like, "Look, I'm gonna be very happy to be a leaser of AI CapEx if I need it, but I'm not interested in overbuilding it myself right now. I think you basically just saying there's a bubble in CapEx build, which has been one of the big drivers of big tech. So." I don't know. Interesting to see how that one plays out.
Isn't he like the biggest? Aren't they like the biggest CapEx spender? I understood.
I don't know. Yeah, maybe they're not the biggest, but basically it's a pretty big tone shift.
I think that something probably has to do with their share price like leaking horrifically relative to the rest of Mag 7, and people probably saying, "Hey, guy, maybe they have to." Yeah, it's interesting. Definitely, a lot of huge shifts that need to occur, I think, in this just economic balance.
What do you think about that yen move? Like, I'm just looking, it's like 151 to like down to 149.
I think it's reminiscent of last summer, without obviously as much leverage built up because of the I think there's just, it's not as like consensusly levered short yen trade, but the dynamics are fairly similar in the sense that, again, I think this is the third week in a row come on here and say, if you look at price action in oil down, yields down, dollar down, that's a sort of a growth scare. And there's just a massive yield differential in the Japanese and European and US interest rates, and Japan's data just keeps coming in hotter and hotter, and they have to take action. So that's a liquidity negative, right? Because, if they start hiking rates, strengthening the yen, weakening the dollar, like what's in the markets start going down, what's the solution there to fix it? Is it, I mean, if you cut rates, you add liquidity, but presumably you weaken the dollar more if your economy's strong in the US and you don't need cuts. So it's this weird thing where, I don't love the outlook for Mag 7, to be honest, or NASDAQ, but yeah, these things take a long time to play out.
Yeah, that should just be our tagline these days. It's just like, as we're in the macro doldrums, as it takes a while. I mean, it is interesting. Like, what we're spelling out here is in emerging markets. But like, have you seen the DAX recently? I mean, we talk about how in the doldrums, like the Germany industrial base is, but like, meanwhile, just pull up this chart of just like DAX is just on a tear. You know, like it's completely antithetical. I mean, this is something you don't like to hear about too. Michael Howell talks a lot about this, which is just like, what's good for the economy can often be bad for markets, and what's good for the markets can often be bad for economy, you know? So even though industrial production in Germany is like just being decimated, German equities are actually doing pretty good.
Yeah, I think I bear posted the bottom of the US Europe ratio. I wasn't taking a position. I was just looking at some things and thought it was funny. But the that was really the nail when the dollar kind of had the nail in the coffin, sort of like weekly doji, like engulfing or whatever, and really provided relief. Everything non-US went on a tear as capital flowed from our indices to elsewhere. But I don't think it necessarily means Europe's in a great place. I think
it's a trade.
Yeah, I would venture to say the emerging market non-US trade is at least this leg of it is probably pretty played out. Like I would guess you're starting to see some rollover in some of these things. And there was also in the Germany side, right, there are elections coming up. So people very hopeful that there's more regulatory friendly regime shift too. So it's, you're in this world where, right, we came into the year with US stocks pretty expensive. Most recently, we've seen a huge rebound in outperformance of international, which they're still obviously relatively cheaper, but pretty overbought in the near term. So it really makes me wonder what juice do we have in the near term to really push. I just think the risk reward, again, like everybody just wants up or down. And I just think sometimes your view is just, I don't know. And the probability distribution and to the upside isn't great, but if you don't have like a bulletproof short thesis, then you shouldn't short things that go up 60% of the time. So sometimes you should just collect 4.5% in the 2-year note and not do much, but that's less sexy of a view.
Yeah. It's, I mean, I agree with a lot of you, and you just, you look at a chart of equities and just been flat. Like you haven't missed anything. I mean, it is testing the high, like the all-time highs right now, which is interesting, but yeah, I don't know. I want to shift this to pairing also with the crypto markets as well, because it's been interesting to see, tying back with our discussion on liquidity right now, which is like neutral, maybe slightly positive, barely, but like when you have a liquidity backdrop like that, the high beta stuff is going to just get taken out and shot, and we've seen that. Like alts have just been absolutely decimated, while the low beta stuff with much more reflexive bids to it, like passive bids to it, equities, we've just been flat. So that tells me that liquidity is pretty neutral. I don't think it's going to turn worse, so maybe that makes for a bit of a bottom here in crypto markets. But yeah, like how are you viewing crypto right now, especially with respect to correlations to TradFi too?
I just don't see much upside liftoff potential. If we went back to 104 or 102, it wouldn't really surprise me. There could be some narrative, or yesterday Trump was in Miami talking about how he saved crypto from the evil Biden administration. It seemed like we popped then, and then Saylor comes out and does another couple billion and cranks his premium down even lower. Like those are just very straight down the middle of the realm of possibility. But every time we get above 100, the sellers kind of come out more in bulk. And I think I think back to, it's like a frame of reference for like how you want to go into like sizing and conviction for a trade, to like late 23, when you had a situation where not even like the crypto natives were fully long, and you're like, okay, this is a really good time where I can buy this asset class, spread my bets into high beta things, and even add some leverage. And your downside is so protected relative to when everybody's screaming at you. I go to like in public, I can't tell you how many people are still talking about crypto, the texts. And then you see these announcements of Abu Dhabi and this family office and whatnot buying, and everyone takes that and says, see, it's bullish, they bought. And it's like, wait,
Market goes down.
yeah, it's and then you think back to the opposite, which was like when the Canadian pensions were puking their bags post FTX because they invested in something they didn't know. That was like in November. That's when you buy. You don't buy after. You don't say it's bullish. These guys are already in the boat. So I think there's a sense of safety because Bitcoin's gone up 120% every year for the last 2 years. And stocks, same dynamic. And what if I don't know, I similarly don't have a terribly strong view. I just don't think the risk reward to the upside is fantastic. And for me, there's a whole world of thousands of tickers I can buy and look at from a macro perspective that hopefully can generate better probability distributions for what I'm trying to do.
Yeah, I'm with you on that. Like that, I don't know. There's either you just buy Bitcoin at range low and sell at range high. Like that's okay. That's what I did this week. It's just like we get down to that point and the shorts are piling in. Open interest blew out because I was like, that's a pretty easy long. But yeah, I don't really see any reason why there should be any continuation. I see no reason for the range to break out higher at this juncture, especially to your point about Michael Saylor, who's been the reason we're where we're at, $22 billion later. He comes out with a $2 billion convert, which is all well and good. And now you're seeing the front run of that and people are buying ahead of it. And then it'll be interesting to see the price reaction once that gets filled and he executes, because like his premium to NAV is not where it was in November. Like when it was at 3, you can just issue equity all day long and just hammer the buy button. But that's not the same situation right now.
Yeah, and volatility's crushed all the buyers that he connived into getting those levered ETFs. They're down 80%. They're just absolutely smoked. Retails from all the altcoins are broke. I mean, I know a lot of people that like came out of the cycle flat, which is kind of remarkable when you zoom out. And if you're long only crypto fund, then I guess maybe Bitcoin is safer. But yeah, what if alts are canary in the coal mine for what happens to Bitcoin when Saylor isn't shoving through $25 billion a year into the asset? Like there's, it's not programmed that it has to go up every year. So I don't know. I want to buy it. I want to get long. I love being long crypto and Bitcoin. That's where I make money and it's fun. But I just like, it's not that attractive here.
No. Yeah. It's either like you just buy the mean reversion trade on alts when they're washed. And I mean, that played out and it's probably over now. Buy the range low and Bitcoin and then sell that rip. And that's played out. But yeah, it's a whole lot of nothing. It's a lot of patience right now. I think that's what we keep getting at. And, you just got to wait for a fat pitch.
Yeah. That's what I mean. That's like the whole functioning of markets is to get you to act. Like CNBC, Bloomberg, news, this, eyeballs, attention, activity. And sometimes you just got to tune it out and like go deep dive the next big thesis or trade. And it's just, you don't want to be the last person at the party. And I think that is the sort of vibe you're seeing these retail. I saw this note today from Goldman on the imbalance of flows skewed towards retail. I mean, up until this week, right? What were the big movers into this monthly options expiration? They were the Cathie Wood stocks, Palantir. They were even the Walmart, Costco kind of high momentum quality are extremely rich. And you look across the universe and there's just not a lot of interesting, I would say, value propositions, and very high sentiment. So well, I guess which sentiment you read, but AAI is coming down. But yeah, I just think there's going to be fatter pitches to be had. And right now, if you're like putting new money to work here, you're kind of betting on everything to go right when you're, in my view, betting against like what probably the odds would say.
Well, I think we'll leave it at that. But yeah, there's a lot of fun monetary plumbing nerdery to do. But aside from that, markets themselves, it's chop to maybe slow grind up in beta assets that have a good bid to them, and some further bleed with the odd mean reversion bounce of shorts covering or whatever. It's nothing sexy.
Yeah, but there's a lot of opportunity, like in some other sectors that have been less loved. I think some of the bright spots on the international front, while probably not good entries, will present other good entries for more medium and long-term holds in the next couple months. Yeah, I think it'll be interesting. To me, the big risk factor here is oil and commodities. If those firm up, you're no longer in this I can look the other way on inflation front, and I think that's could be a thing to see. The other side of it too is if the dollar keeps going down, without that sort of provides a floor, right? It's pretty inflationary. We benefited from a strong dollar the last few years, where our imports are relatively cheaper, and if you're no longer in that dollar dominant environment, your inflation is sort of worse than everybody else's inflation. So things to keep in mind, where everybody's pounding the table, weaker dollar is really, really good for US assets is potentially not the case this time.
Yeah. Agreed. All right, man. We'll leave it at that. Have a good weekend. Everybody tune in next week for Jim Carson. It's going to be a really fun episode.
I should have, dude, I was just thinking, I didn't wear my USA hat. We're gonna whoop you guys again tonight. I didn't even have it on.
Don't even bring up that can of worms, dude. It's about to go down. Canada, US hockey, best on best. It's gonna be like 2010 again. It's gonna be. I can't wait, man. I'm so excited.
That game was so fast paced, like, and intense from
three fights in 9 seconds.
It was just like one of the best sporting events I can remember in a long time.
Yeah, I will say I was disappointed that my country was booing the national anthem. I don't think that's cool. I'll say that. I'll give that one. Just leave it to the fights. Right. Leave it to the boys to chop it up on the ice.
Yeah, 51. They should get their. If the U.S. wins, we should get 51. On our hats.
Yeah. See, I'm more okay with those jokes because we booed your national anthem, so we'll take the L on the 51st state jokes.
Governor Trudeau.
That's an insane tweet.
That was classic. Yeah. There's only just missing the fence czar.
Yeah, exactly. Yeah, we'll see what happens in this game tonight. But only one country can win to see on the other side.
Sounds good, brother. Have a good weekend.
See you.